Hi everyone. Today I'm doing a quick video on something that a lot of people aren't aware of. Did you know that you can use your IRA or Roth IRA to invest in recession-resistant assets? Today I'm going to talk about self-directed retirement accounts, which give you more control over your money and allow you to invest in alternative assets outside of stocks and bonds. I'm Jared Murmas, managing partner at Mainstay Global here in Austin, Texas. We're a private equity firm focusing on high-quality commercial real estate investments for our clients. Most people are familiar with the two most common types of retirement accounts and their tax advantages. You have 401ks, which are offered through your employer, and then there are IRAs, which are either rolled over from a 401k when an employee leaves a company, or they're simply set up by anyone who wants to start saving for retirement. IRAs come in two flavors: the traditional IRA, where you contribute tax-free dollars and pay taxes later on in retirement as you make withdrawals from the account. Then there are Roth IRAs, where you invest after-tax dollars and all of your withdrawals that you take in retirement are completely tax-free. The overwhelming majority of these retirement accounts are kept with one of the typical household name brokers like Fidelity or Vanguard or T. Rowe Price, and you can only invest in stocks, bonds, and mutual funds and some other common investments. Now, I'm not knocking stocks and bonds. The stock market has certainly been on a tear over the last few years. But the one thing that every financial advisor recommends is to diversify your portfolio. We're currently in the longest economic expansion in U.S. history. You can see the current and last two boom and bust cycles over the last 23 years in this chart showing the S&P 500. Most economists expect to see at least a mild recession next year. Hiring has slowed, and the yield curve is inverted, which has long been seen as an early predictor of recessions. We think recession-resistant investments that can weather economic volatility make a lot of sense at this point in the business cycle. And the best way that you can take advantage of these types of recession-resistant assets is to buy them through private placements, which you can do with a self-directed IRA. With a self-directed IRA, you can invest in just about anything with the exception of collectibles and life insurance. You can invest in precious metals, oil and gas, or if you've got a pretty high risk tolerance, you can even invest in startups. And if you're one of those that like to have a hard asset backing up your investment, you can invest in real estate. You can go out and buy distressed property and rehab it and sell it. And if you don't mind all the hassles and headaches that come with being a landlord, you can buy rental houses. Or you can do what most wealthy people who value their time do, and that's investing in commercial real estate as a passive limited partner. Investing as a limited partner in commercial real estate is for those who like the intrinsic value of real estate, but either don't have the expertise or don't want to spend all of their time finding, acquiring, and managing a commercial real estate asset themselves. They want their money to work for them, not the other way around. They also enjoy the higher returns that commercial real estate typically provides versus investing in single-family rental houses. The vast majority of commercial real estate deals are funded through private offerings, mostly made available to accredited investors. Accredited investors have a net worth of $1 million or more, not counting their personal residence, or they have annual income in excess of $200,000 over the last couple of years, or $300,000 when combined with their spouse's income. Many of these private offerings offer preferred return to their limited partners. So as an example, if a private offering has an 8% preferred return, the investors need to make 8% on their money annually before the sponsor makes any promoted profits for themselves. These preferred returns are often paid out quarterly. And when the sponsor sells the asset, the investor's total return usually ends up being much greater than the preferred return alone. So there's significant upside. So you may ask, isn't commercial real estate susceptible to an economic downturn just like the stock market is? Most asset classes are, with the exception of a few recession-resistant assets. One asset class that did well during the Great Recession was self-storage. While other commercial real estate classes took a huge hit with a massive drop of 38%, self-storage actually showed a gain of 5% during that time. Anytime there is a life-changing event that causes people to move into a smaller house or apartment, they often use self-storage to hold all their stuff because there simply just isn't enough room for all of it to fit in their new place. And unfortunately, during an economic downturn, you see a big increase in people moving into smaller places, either because of foreclosures, job loss, and other life-changing events that are exacerbated by tough economic times. So while self-storage may not be the sexiest asset class in commercial real estate, it is certainly one of the most recession resistant. In addition to having the right risk profile for any upcoming economic headwinds, I'm most excited about our MG Self-Storage Fund because it's bringing a disruptive concept to the self-storage industry. We've got a seasoned sponsor who's introducing advanced technology to the self-storage industry by buying undermanaged mom and pop owned facilities and converting them to unmanned operations. The other great thing is that the sponsor has already implemented unmanned operations in 10 facilities that it already owns. So it's a proven value-add business model that increases NOI while avoiding the risks inherent in development of new facilities. So if you're an accredited investor, this is an example of a recession-resistant asset that you can invest in with your self-directed IRA. With any IRA or 401k, either traditional or self-directed, you need a custodian or trustee to hold the account for you, and there are a number of SDIRA custodians out there. There are two main distinctions in SDIRA custodians, ones that give you checkbook control and ones that don't. And by checkbook control, I mean you don't have to wait to get the custodian's approval before the investment check goes out, which sometimes can take several days. With checkbook control, you simply write out a check or you wire funds directly out of your LLC account. SDIRA custodian fees can be steep, particularly the ones that give you checkbook control, so you're going to want to do your homework. We've partnered with one of the lowest SDIRA custodians out there, Rocket Dollar. They have a really easy account setup process. It's all done online, and their costs are pretty transparent with a one-time sign-up fee and a really low flat monthly fee. Now pay attention to the next slide if you want to save $100. Rocket Dollar is making a special offer for our clients. If you go to rocketdollar.com and enter the code Mainstay19, you'll get $100 off of the sign-up fee. So to sum it up, combining the tax advantages of an IRA account with the portfolio diversification of commercial real estate investing can be a powerful combination, particularly when you're able to invest in recession-resistant assets. If you have any questions, please email us at info@mainstayglobal.com. Thanks for watching.